Have you ever felt confused and overwhelmed with all of the different types of retirement plans that are out there and thought to yourself, which is the right one for me? Then you'll like this two-part video where we will be reviewing the various types of qualified retirement plans, some that are a little bit more common and some that maybe you haven't heard of yet. Let's get to work. What's up, friend? I'm Kay Scholl. Welcome to another financial awareness video. If you're trying to make better financial decisions, grow your wealth and financial literacy, then you're in the right spot. In this second video, we'll be reviewing some of the plans that you might have heard of but aren't really sure which one is right for you. The SEP IRA, Simple IRA, and Individual 401k. Now, if you want to go ahead and jump back to video number 1 where we reviewed these plans, then go ahead and click this link right here. That first video was designed for W-2 employees, and this video has been created for you if you are self-employed, a business owner, or have any 1099 income outside of your normal W-2 paychecks. Choosing a retirement plan for your business is a decision that can profoundly impact the long-term financial well-being of you, your employees, and your company. With many types of retirement plans to choose from, the best one ultimately is the one that meets the needs of everyone involved. First batter up is the SEP IRA. SEP stands for Simplified Employee Pension, but nobody really says the full name, so just stick to SEP and most people worth their salt will understand. Unlike some retirement plans that require the employer to match contributions, one of the main benefits of the SEP is that it is completely flexible and you have the discretion to choose to contribute to it on a year-by-year basis. So this type of account is best suited for self-employed individuals or owners of small businesses where revenue might fluctuate each year. For example, realtors, barbers, hairdressers, cosmetologists, professional photographers, groundskeepers, landscapers, YouTubers with no full-time staff, or really any individual with 1099 income. Currently for 2020, the maximum you could put into your SEP IRA is $57,000, or if you are the owner of an S-Corporation or C-Corporation, 25% of your wages. Keep in mind, though, that if you take any distributions to the form of a K-1, that is not included in this calculation, even though that K-1 distribution might flow all the way to your personal tax return. This would be 25% of your wages, which does not include K-1. If you are a sole proprietor, this is reduced down to 20% of your net income, or up to the maximum of $57,000. The employer contributions are tax deductible and will grow tax deferred, but that is true of many other qualified retirement plans as well. So the real benefit of the SEP IRA over your other options would be the sheer size of how much you can put in. $57,000 is way more than $6,000 into a traditional IRA, which has income limitations, by the way. It also is very affordable to open, maintain, and has very low administration cost. And then number 3, it's completely flexible. You have the option of choosing how much you want to put into this account every year. If you find any value throughout this video, hit that like button. That one simple action by you will help someone else make smart, educated decisions about their finances. This leads us to some of the downsides of the SEP IRA. Although you are not required or obligated to make a contribution every year, if you have any eligible W-2 employees working for you when you have a SEP IRA and you make a contribution, you have to make the same percentage contribution for each eligible W-2 employee. Let me say that again. The same percentage contribution. Whoa. Just do the math on that because this might make you reconsider the SEP IRA as an option. More on that in a moment. Now, you might not have heard me say eligible employee a moment ago, but you should be aware that an eligible W-2 employee of your company is somebody that has been employed by you for 3 out of the preceding 5 years. This rule was put into effect because some employers would terminate an employee on paper and then rehire them to avoid the eligible employee status. This is why the rule states 3 of the preceding 5 years. It is to protect the employee. You also can't borrow against your SEP IRA, which usually isn't a good idea to begin with anyway, but if you need to pull any money from this account, you actually have to take it out of the account, and you'll be assessed a 10% penalty if you're under the age of 59 and a half. However, during this very unprecedented time that we're in right now, due to the CARES Act that was just recently passed, you can pull any money from your SEP IRA or any other qualified retirement account up to $100,000 between January 1st of this year and December 31st of 2020, and you will not be assessed that 10% early withdrawal penalty, but you will still have to pay taxes. If your business will always employ you or you and your spouse, then the SEP IRA is going to be one of your best options. However, if you plan on growing your company and actually hiring W-2 employees employed by the company one day, then you might want to consider terminating the SEP IRA before your employees become eligible and taking those funds and rolling them over into your personally owned traditional IRA and then opening up a new qualified retirement plan for your company, like a simple IRA. The Savings Incentive Match Plan for employees allows employees to elect to contribute a portion of their compensation into the plan on a pre-tax basis. The employer is generally required to match each employee's contribution up to 3% or make a non-elective 2% contribution into the plan. This is a good plan for companies that have 100 employees or fewer, or any individual seeking an alternative to the 401k plan. Many of the features of the simple IRA are very similar to the SEP IRA in the fact that it is very easy to establish and maintain and also has low administration costs. The contributions are tax deductible and they grow tax deferred. The employees are now able to deduct a portion of their salary, which is nice for them. The employees are also 100% immediately vested in all of the employer contributions, and there are catch-up provisions for people that are 50 and older. There are some restrictions to the simple IRA as well. Just like the SEP IRA, there are no loan provisions. However, unlike the SEP IRA, the employer contributions are mandatory each year. Also, if you remember, with the SEP, you can contribute up to $57,000 each year. However, with the simple IRA, you can only contribute $13,500. The individual 401k plan has the same rules and regulations as a normal 401k plan, so you might want to go back and watch the first video for all of those specifics. These plans are geared towards people with companies that have no full-time employees other than the other business owners and their spouses. They also offer a high degree of flexibility for plan contributions each year. If you are an independent contractor, consultant, sole proprietor, or in a partnership, you should at least consider an individual 401k as an option. Some of the benefits of the individual 401k are very similar to the SEP and simple in the fact that your contributions are tax deductible and they will grow tax deferred. You can contribute up to $19,500 into your individual 401k each year. However, unlike the SEP and the simple, since the individual 401k is operated just like a normal 401k, you could include a Roth Provision. This would allow you the opportunity of contributing $19,500 into a Roth 401k each year. If you, as the employer, still make a match or a profit sharing into your individual 401k, they would still have to go into the pre-tax individual 401k account. Unlike the other IRAs that have been mentioned before, you do have a loan provision within your individual 401k. Not that it's a great idea to borrow from your retirement, but it is a nice benefit to have if you choose to open up an individual 401k. There are some trade-offs of the individual 401k that you should be aware of. You are not required to hire a third-party administrator known as a TPA, and you could act as the administrator yourself. If you will administer your own plan, the benefit would be that you'll be keeping your annual costs lower, but the downside would be that you'll be taking on more personal responsibility of managing and maintaining the plan, which could result in less productivity growing your business. For example, once your cumulative plan value exceeds $250,000, you'll have to file Form 5500-EZ, but don't worry too much because your CPA or accountant can whip that up in probably 10 minutes or less. Make sure you lean on your qualified CPA professional for any questions about the rules and regulations of an individual 401k. However, when it comes to more complicated matters such as this, that is exactly why people hire third-party administrators just to manage and maintain the plan. When you go down that path, the cost each year is higher than if you manage it on your own. So as I mentioned at the beginning of this video, the best retirement plan for your company is typically the one that benefits all parties involved, and cost is certainly one of those factors. Thanks for watching. Appreciate your time. If you want to watch part 1 of this video, go ahead and click this link right here. If you have any questions for me, leave them in the comments down below. Thanks. Go live your best life.